war, geopolitics, and gold have always been deeply connected. Whenever the world becomes unstable, gold moves into the spotlight. But why does this happen? And why do many people say gold can fall, but it can never go to zero? Today, we'll break this down step by step, slowly and clearly. War is not just about weapons. War disrupts economies, supply chains, and trust. When conflict breaks out, the first thing people lose is a sense of security. And when trust disappears, money looks for safety. That's where gold comes in. Gold doesn't depend on any single government. Gold can't be printed overnight. Gold doesn't carry default risk like bonds do. That's why during wars or geopolitical tensions, investors turn to gold, not because gold is better, but because it's less risky. Geopolitics doesn't always involve military conflict. Trade tensions, sanctions, frozen assets, all of these matter. They make the global financial system feel fragile. When one country's reserves are frozen, others take note. They start asking, is our money really safe? That's when central banks increase gold reserves, not to speculate, but to reduce reliance on the existing monetary system. This is why gold continues to be accumulated at the national level. Now let's talk about the most important concept, real interest rates. Nominal interest rates are what banks advertise. For example, a 5% savings rate. But what if inflation is 7%? Your purchasing power is actually shrinking by 2%. Real interest rate equals nominal rate minus inflation. If that number is negative, your money is losing value. Gold doesn't pay interest, but gold protects purchasing power. When real rates are negative, holding cash becomes risky, and that's when gold becomes attractive. When real interest rates rise, bonds and savings look more attractive. Investors have better alternatives than gold. During these periods, gold may decline or move sideways. But that doesn't mean gold is dead. It simply means defense is temporarily less important. Now let's answer the big question. Why can't gold go to zero? First, gold is a scarce physical asset. You can't create gold out of thin air. Second, gold has real-world uses. Jewelry, technology, medicine, industry. Third, gold has been a global store of value for thousands of years. No fiat currency has lasted as long. Fourth, gold has no default risk. Companies can go bankrupt. Governments can lose credibility, but gold doesn't need a guarantor. Gold can fall 20%, 30%, or more. That's completely normal, but falling is not the same as going to zero. Gold is not a fast growth asset. Gold is protection. It's like insurance. You don't buy insurance to get rich. You buy it so you don't lose everything. War and geopolitics increase the need for safety. Real interest rates determine gold's short-term performance. But long-term, gold survives because of trust. Trust that value can't be printed endlessly. Gold isn't about getting rich fast. It's about preserving what you already have. This is my personal perspective. This is not financial or investment advice. If you found value in this video, like and subscribe. See you in the next one.